every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis, welcoming you to the final Money Talk of the week on Friday the 12th of January 2024. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, Taiwan is heading to the polls tomorrow to elect a new president and legislature. The election will be closely watched by the world for how it will affect the island's relations with China and the US. The presidential candidate for the Kuomintang, Taiwan's largest opposition party, which is in favour of closer ties with China, has excluded the possibility of talks with China on unification if he is elected. Ho Yi on Thursday said that a victory for the KMT would not allow Beijing to gain control over the country as it desires. He said he would not touch the issue of unification while in office. US headline inflation edged up in the year to December as the Federal Reserve deliberates over when to cut interest rates from their 23-year high. The annual consumer price inflation rate rose 3.4% in December from a 5-month low of 3.1% in November, exceeding economists' forecasts of 3.2%. The annual core inflation rate eased to 3.9%, below 4% in the previous period, but above expectations of 3.8%. Compared to November, core consumer prices rose by 1/3%, the most in 3 months, and above forecasts of 0.2%. The Bank of Korea left its benchmark lending rate unchanged for the 8th time in a row Thursday. South Korea's central bank held rates at 3.5% in line with economists' expectations amid a further slowdown in inflation, record household debts and growing credit risks associated with a local developer. 11 asset managers, including BlackRock and Fidelity, have had applications to launch spot Bitcoin ETFs approved by the US Securities and Exchange Commission. Bitcoin trading volumes surged 40% Thursday over the previous 24 hours after ETFs made a long-awaited debut on stock exchanges. Over $3.5 billion of ETF shares have changed hands as of 1 p.m. in New York. On Thursday, Bitcoin was up 2% to just above $46,000, having risen above $49,000 at one stage. Ether was up almost 7% to $2,594 on speculation that Ethereum could be the next cryptocurrency to receive ETF approvals. On today's programme, I'm joined by Francis Lun, the CEO of GEO Securities, and Carlos Casanova, Senior Asia Economist at UBP. With a view from Australia is Toby Lawson, CEO at Statton Partners. I have a daily newsletter to accompany this podcast, which contains more business and finance news from across Asia, and you can find it by going to peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks closed almost unchanged as traders assessed inflation data that was higher than expected in December. The benchmark S&P 500 fell less than 0.1% to 4,780, with utilities and rate-sensitive real estate stocks dragging the index lower. Earlier in the session, the broad market index briefly traded above its record closing high. The tech-heavy Nasdaq Composite was flat, settling at 14,970. The Dow eked out a gain of 15 points, that's under 0.1%, to close at 37,711. The KBW Nasdaq Bank Index fell 1%, ahead of quarterly earnings reports from the largest US banks later today. Trading in the bond market was choppy following the inflation data for December. The 2-year Treasury yield, which moves with rate expectations, rose immediately following the publication of the data, but later reversed that move, leaving the yield at 4.25%. That's 12 basis points lower from when the data was released. The 10-year dropped below 4%, losing 6 basis points to 3.97%. The US dollar index ended the day where it started, around 102.31, after jumping higher in an initial reaction to the CPI data, but then fading for the rest of the day. The yen outperformed, rising 1/3% to 144.32 against the dollar. The Chinese yuan was almost unchanged in Shanghai at 7.1670 renminbi, ahead of inflation data and trade data later today from the mainland. Spot gold prices tumbled back below $20,020 on the hotter-than-expected CPI data, but then bounced back again as traders reassessed rate cut expectations. Gold ended the session 0.2% firmer at $2,028 an ounce. Oil prices jumped Thursday after an oil tanker was hijacked by armed militia near the Gulf of Oman. The Brent futures contract for March settled 0.8% higher at $77.41 a barrel. Hong Kong stocks rose for the first time in 2024 yesterday, arresting a 7-day slump. The Hang Seng Index jumped 205 points, or 1.3%, to close at 16,302. It rebounded from a 14-month low hit earlier in the week amid mounting bets of policy easing from the PBOC, including cuts to the RRR. Gains were broad-based, with the tech index up 2.2%. And on the mainland, the Shanghai Composite rose 0.33% to 2,887. The CSI 300 rebounded 0.6% from an almost 5-year low hit on Wednesday. Doesn't look like that rebound in the Hang Seng is going to last very long. Futures markets pointing to a decline this morning of 120 points for the Hang Seng Index. Should start trading at around about 16,180. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
We've reached the end of the week, and let's welcome Francis Lun, our regular Friday commentator, the CEO of GEO Securities. Morning, Francis.
Good morning.
And also joining us is Carlos Casanova, who's Senior Asia Economist at UBP. Happy New Year, Carlos.
Good morning and Happy New Year, Peter.
Thank you. Let's start with the Taiwan election. Taiwan's heading to the polls tomorrow to elect a new president and also the legislature as well. The election is going to be closely watched for how it will affect the island's relations with China and the US. The presidential candidate for the Kuomintang, which is Taiwan's largest opposition party, which is traditionally in favour of closer ties with China, has excluded the possibility of talks with China on unification if he's elected. Ho Yo-yi on Thursday said that a victory for the KMT wouldn't allow Beijing to gain control over the island as it desires, and he said he wouldn't touch the issue of unification while in office. Francis, how significant is this election? I suppose a lot depends, doesn't it, on who wins and how China reacts to that.
Yeah, I think for the general public in Taiwan, I think they have aversion to unification with China. And don't forget, Mr. Hao used to be a DPP member.
He was, wasn't he? Yes, that's right.
So which means you really have two DPP members running for office. As you lose and tails you lose. So it really comes to the point that the Chinese government invested so much money on Kuomintang and ended up with a candidate that's not favor of unification. It's really not the result that what China wants. But the general consensus is the DPP will win again this year because you have three candidates, and then the Professor Orr split the vote from KMT, so which means there's really little chance for the KMT to win the presidential election.
How do you think China will react to that?
Well, I think it will further try to isolate Taiwan because when Ma Ying-jeou was president, I think China allowed Taiwan to have a diplomatic relationship with something like 25 small countries. Now it's down to almost something like 10 or something like that. So China will increase pressure on Taiwan internationally.
Okay. I mean, Carlos, as well as obviously US-China relations, which is going to be a key focus in this election, maybe the key focus. Of course, as always in elections, the economy, the local economy, is a big issue as well. Last year, it was a tough time, wasn't it, for Taiwan's economy because of the slowdown in the global semiconductor cycle with less demand last year for chips. But how are things looking going forward?
That's right. So there are a few criticisms of the DPP if you follow the debate in Taiwan. One of them being the deterioration in cross-border relations, of course. A second one being, increasing the mandatory military service time from 4 months to 1 year. So that's where I am not with Francis 100%. I think it's actually quite a divisive election, and we might just end up having a hung parliament as opposed to a landslide victory from DPP like last year. But this is something that concerns a lot of Taiwanese people because not everybody wants to go to war with China. And the third is, of course, the fact that the economy has been rather sluggish. Part of the, Xinanxiang or new southern strategy that TPP started to implement 8 years ago was to increase outbound foreign direct investment into Southeast Asian countries in the hopes to relocate some of the low value added manufacturing from China to Southeast Asia, and then to reshore some of the high value added manufacturing back to Taiwan. And for that, they needed to keep wage growth pretty flat. And so people are feeling that wages haven't kept up with the pace of inflation and also the rise in housing prices. And so this is one of the key criticisms of the TPP. I think that the semiconductor cycle has been rather unfortunate for them in terms of election timing, especially as we are entering a recovery in the global semiconductor sector. And we do expect the Taiwanese economy to recover in 2024, 2025 as a result. But it is what it is. Unfortunately, it has been, between COVID and the weak semiconductor demand in the last 2 years, the economy has underperformed. And so I think that's one of the things that might drag on their support base for the election tomorrow.
However much the DPP or any of the parties try to wean the economy off of China, the fact of the matter is it's going to be almost impossible to do, isn't it? Taiwan is going to still be very dependent upon the mainland Chinese economy as well.
I think it's not impossible, but it takes a lot of time. So many companies, including Apple, have been looking to wean themselves off China. And of course, Foxconn, a Taiwanese company, is in charge of assembling most of the iPhones for Apple in China. They have a plan to shift capacity to India, about 10%, I think it is, by 2035 or something like that. So it takes a long time. And even if they do succeed at doing so, 70% of iPhones will still be assembled in China by Foxconn in the next 20 years. So we are looking at a very, very gradual sort of de-risking, if you may. I think that word gets thrown out a lot nowadays, as opposed to a complete divorce in sort of economic ties between Taiwan and China.
Francis, one of the things that was noticeable last year, despite the slowing economy, the Taiwanese stock market was a real standout performer. It was one of the best performing markets in Asia, wasn't it? I think it was up about 27% at the end of last year, only just behind Japan.
I think that can attribute it to the success of the tech sector in Taiwan, especially TSM. Because somehow Taiwan emerged as the leader for manufacturing chips. They can manufacture the smallest chips in the world. And that sector actually carried the Taiwanese economy. And even though the global sales of smartphone did not increase last year, but Taiwan's share of the global business actually increased. So what you see is the stock market doing quite well in Taiwan.
And of course, one of TSMC's biggest customers is NVIDIA, which is surging itself because of the demand for AI chips. Is this going to be a potential boost for Taiwan as well? Because Taiwan Semiconductor obviously manufactures those chips. So is it going to be a big beneficiary from the AI boom this year?
Yeah, definitely. But don't forget, TSMI's big customers also China. Huawei used chips manufactured by TSMC. So you can talk all you like, but the fact is that the pocketbook says something else. Taiwan is very dependent on China for business, and without China's business, I think that Taiwanese economy will go back 50 years, something like that.
I mean, Carlos, is obviously semiconductors is the dominant part of Taiwan's economy. Is it? So I've heard some complaints, particularly actually surprisingly maybe from young people, that actually the semiconductor industry is too big in Taiwan, and Taiwan's semiconductor in particular is so large that it drains resources from other parts of the economy. I mean, it gets the best graduates going to those companies and that particular sector. Is there some truth in that, do you think?
I think there is some truth in that. I mean, I don't have the exact figures, what percentage of Taiwanese GDP is derived from semiconductors, but do keep in mind that TSMC is one of the most important companies in the world. It is definitely the most valuable company in Taiwan, and so inevitably it is going to attract some of the best talent out of universities. I would say that TPP has actually, to that regard, been trying to diversify away from just semiconductor, upstream high value added design, and then some assembly of like really small chips, into other types of high value added services. They've tried to attract a regional headquarter for Google by offering subsidized electricity prices. So they are trying to sort of within the scope of tech and high value added services, they have been trying to diversify away from just semiconductors. And I think it is a strategy that will pay off, but it requires a little bit of time for us to see those benefits. And remember also that Taiwan, is bigger than many European countries. And so it does have a very strong industrial base, especially around Taichung, with plastics, also metal smelting. So it is unfair to say that semiconductors is the only driver of economic activity in the island.
So where does the new government, whoever that is, turn the economic focus after this election? If it wants to be maybe less dependent upon China, what does it look towards? Where does it go?
In all honesty, it will have to be, and you are seeing it with some of the rhetoric coming out of the KMT, right? They're also saying a few days ago that the one country, two systems is not applicable, a model that is applicable to Taiwan. So I think it's going to have to be an extension of policies by the TPP. You can criticize them as much as you want, but this reshoring of high value added manufacturing is actually the right strategy for them. And then this diversification into Southeast Asia is actually also the right strategy to pursue. So I feel like it's going to be an extension of what we have seen in the past, which entails that you are going to continue to see large portfolio investments into Southeast Asia, and also you will continue to see very stagnant wage growth in Taiwan, unfortunately for the Taiwanese youth, which is of course also one of the main constituents of the TPP. But it is that, or they become irrelevant, or they are not able to generate enough jobs for the population at home, and so it is better to have flat wage growth than to have high unemployment ultimately. So I think it's going to be an extension of what we have seen so far.
This is a problem, isn't it, for Taiwan? It does have a reputation for low wages. It has a reputation for expecting people to work for free, basically to do overtime and not get paid for it. That seems to be the culture there. But young people in particular, very unhappy about that, obviously.
But often you hear them criticize the wage policy in regards to their ability to access housing. So I think one low-hanging fruit where they could improve is to ensure that there is more affordability within the housing sector, increased supply of social housing, for example, in order to address some of the concerns around flat wages. But they cannot afford to have a big increase in wages, or a lot of those semiconductor jobs would go elsewhere. Malaysia, for example, is positioning to capture some of those high value added semiconductor jobs. So I think they have to keep things as they are for the time being.
Francis, is there a risk that foreign investors, just as they're turning away from mainland China, may also see need a bigger risk premium for Taiwan as well? They see Taiwan now as becoming more risky to invest?
Yes, that's quite true. But the fact is, sometimes you don't really have a choice. Like in the semiconductor industry, you have to go to ASML to buy the etching machines and to buy photo machines from Japan. You don't have any other choice. Like if you want to buy chips, you have to have them manufactured in Taiwan, Japan, or South Korea. There are no other places that they have the capacity or the ability to make them. So I think what we have is really a global division of labor. And actually, Taiwan occupies a very critical value chain in this manufacturing process. So I think Taiwan should exploit its leading status in semiconductor rather than complaining about it.
And what countries like the US are trying to do, of course, is to get Taiwan to build factories offshore in the US itself to try and reduce that risk and reduce that dependency. But how is that working out? Is it going well?
That is a non-starter because U.S. wages and social policies are really much too high. I think manufacturing costs in the U.S. something like more than double that of Taiwan. So although TSMC said that they will build a big factory in Arizona, and I don't think it's going well. Even for Honghai, they were going to build a big factory in Wisconsin, but I think basically. Mr. Kwok killed it already. I think it's not going anywhere.
And that's despite all these big subsidies that the US government provides to TSMC and Foxconn and others.
Yeah, that's right. Because living costs in the US are much too high. So that translates into manufacturing costs, which is more than double that of that in China, Taiwan, Hong Kong, or even Japan. So I think, well, if what you really have to go with the International Division of Labor. The U.S. is good that they are leading the world in innovation. Once they lose the advantage or that lead, I think the economy really suffer enormously.
Okay, well, we'll see what's going to happen over the weekend in this election. We'll be talking about it on Monday morning in Money Talk. In the meantime, let's turn our attention to the US because headline inflation edged up in the year to December, complicating the Federal Reserve's calculations over to when to cut interest rates, which are currently at a 23-year high. The annual consumer price inflation rate rose 3.4% in December from a 5-month low of 3.1% in November. That exceeded economists' forecasts of 3.2%. The core rate eased to a 2.5-year low of 3.9%, but that was also above expectations of 3.8%. And compared to November, core consumer prices rose 0.3%. That's the most in 3 months and above forecasts of 0.2%. Carlos, how much attention should we put on this report? Because obviously it's not the favoured measure of inflation, is it, that the Fed looks at? But nevertheless, is this showing that maybe inflation still isn't fully beaten yet? Or is this, or are we talking about small amounts here in terms of the misses on inflation?
Yeah, so it's not a core PCE, of course, but the Fed is looking at all measures of inflation and the other side of the coin of the Fed's congressional mandate, which is unemployment, in order to calibrate its response in 2024. And unfortunately, the picture is quite mixed. So we are seeing some weakness in manufacturing. We saw the PMI dipping into contractionary territory. At the same time, we are seeing sustained CPI, which, granted, take it with a pinch of salt because it's December, it's ahead of the commercial season. Typically, you do have an increase in prices around the Christmas season. But that is also coincided with fewer applications for unemployment benefits and some signs that there is resilient strength in the labor market. So definitely that sooner rate cut in March is off the table. I think the market is still pricing a 69% chance, as you've mentioned, of a rate cut, but in our opinion, it's rather unlikely. we might see a pivot take place in May or in Q2. But the risk here is still to the downside, meaning a later start to rate cuts and also fewer than the 4 that are currently priced in by the dot plots or the 6 that are currently priced in by the market in 2024. So I think it's very relevant. And I think investors will be pouring through every single data point in the next few months to try to assess exactly what their asset allocation should be entering this rate cutting cycle.
So, Francis, what does this mean for markets? Does this mean that maybe a March rate cut that the markets have been assuming is off the table?
Definitely. The January, the December inflation figure does not take into account of the big detour around Cape of Good Hope, Africa, because they will raise the freight rates from Europe to Asia by 100%. So what we're seeing is that actually inflation is ticking up in 2024 rather than going down. So I think the prediction were too optimistic. I think you will probably see the first rate cut maybe in the second half of this year, because last night the Iranians took one of the tankers in retaliation for the U.S. action last year. So I think the oil prices will shot up already. So you have all these various unfavorable factors. So I think instead of inflation going down, you will see inflation going up in the short term. That means rate cut will be delayed for some time.
Carlos, one thing that's quite encouraging, I suppose, is consumers, their expectations for inflation is coming down now. They're about a 3-year low, I think they are, according to the New York Fed. That is encouraging, isn't it? Because it's important that inflation expectations don't get embedded in consumers' minds.
That's right. So inflation expectations are still to the downside. The other factor that's complicating the outlook for us economists in the US is the fact that there is a strong base effect next year, which is going to help to keep some of those pressures that Francis was mentioning under control. So in spite of disruptions to supply chains and in spite of some of the issues surrounding the geopolitical risks to oil prices, we think that this base effect will still enable inflation to decline to around 2.5% by the end of 2024. That remains above the 2.0% target that the Fed has decided is their long-term level of inflation. But we are assuming that 3% is a new percent. So if we see a deterioration in macro activities, especially on the manufacturing side, we're assuming labor and consumption will remain strong, and with this expectation that inflation is coming down, it should be the case. But if we see a sharper decline in manufacturing, with this inflation trajectory heading towards a 2.5% target by the end of the year, they should be in a position to pivot. But I totally agree with Francis. It will be delayed, and it won't be as rosy as some of the analysts in the market have started to price in.
Okay, Francis, let me ask you about Bitcoin. The US Securities and Exchange Commission has approved now the first spot Bitcoin exchange-traded funds. This is really a landmark event. 11 asset managers, including some big ones like BlackRock, Fidelity, have had applications to launch their spot Bitcoin ETFs. They started trading today. Volume surged. Bitcoin volume was up about 40%. There's been something like $3.5 billion of ETF shares changed hands by about lunchtime in New York. Does this change the landscape for investing in Bitcoin?
Yeah, definitely. I think basically the SEC legalized it and said, well, it's okay for you to speculate. And I think a lot of the speculative money will go into Bitcoin. And of course, the bulls said that Bitcoin will rise up to 100,000 this year.
I heard, Kathy Wood was saying that by 2030, she expects to see the Bitcoin price at $1.5 million per coin.
Oh, no. I hope she's fully invested in Bitcoin.
I think she is. I think she is. She's been a big fan for a while.
For all my money, I will sell all my properties and put everything in Bitcoin.
Yes, yeah. I mean, Carlos, despite this, Bitcoin's no closer, though, to becoming a global currency, is it? It's still a long way off from that, even if this does encourage investors maybe to look more at cryptocurrencies.
I agree. I think what we are seeing is a reversal of some of the conditions that led to the decline in Bitcoin prices. The decline in US 10-year yields, the expectation that the Fed is going to start cutting rates. Remember that Bitcoin is a hedge against central bank policy. And so it is possible that and also an increase in geopolitical tensions, by the way, with the record election year and everything that is happening in the Middle East. So we could see some upside to alternatives, Bitcoin being one of those. And so we do think that the current environment might benefit Bitcoin and other asset classes such as gold, coal, other defensive trades like that. But it remains a very speculative bet, in my opinion. And of course, that regulatory headwind is still there. So it is not for the faint of heart.
I wonder what this means for these Bitcoin exchanges, because I would have thought it's not great for them, because why would you go and invest now in a Bitcoin or put your money on a Bitcoin exchange where there's the risk of your wallet being hacked and losing all your money, or you forget your password and can never access it again, when now you can just go and buy an ETF? That seems to be the much safer route now.
Yeah, definitely. That's a much safer bet, because when you have FTX, the Sam Bankman-Fried stealing $8 billion from investors, who would want to invest in an exchange, and regulated exchange at that? So I think it's actually good news for the retail investors.
Does it encourage Asian regulators, to go and follow suit and start authorizing similar products? We know Hong Kong, for example, wants to be a center for cryptocurrencies, for digital assets. What does it mean for Asia?
Well, definitely. They will give a big boost to Hong Kong, because China deliberately leave a loophole for Hong Kong to go into cryptocurrencies and virtual assets like that. And in no other place in China, you can do virtual assets legally except Hong Kong. So I think that is a road forward for Hong Kong to be a virtual asset center for China.
Carlos, the SEC hasn't done this very willingly, though, have they? When you listen to their press conference yesterday, they spent most of it talking about the risks of investing in Bitcoin, saying to people that this wasn't an endorsement of cryptocurrencies at all. You really got the impression that they almost didn't want to do this.
Yeah, agreed. Well, it is a risky asset class. It's an artificial market in the sense that there's created scarcity and then investors pour in. So I do understand the concerns. However, there's a lot of demand and requests to have a more transparent investment environment. Even within Asia, a lot of investors are asking about digital assets, crypto assets. So it is inevitable that we will see a more formal investment environment. And I think Hong Kong is definitely at the forefront of that effort in the region. Singapore tried, but there were some difficulties. So I think Hong Kong will likely take the lead, and it hopefully should help with the business volumes. But it is a risky asset class. And so I think people getting into it, even if they're buying an ETF, have to be cognizant of those risks.
Francis, before we go, let me just get your thoughts on the Hong Kong market. Hong Kong stocks went up yesterday. Hooray, for the first time this year. Doesn't look like it's going to last very long, though, because futures markets are pointing back down today. But it's been a pretty dreadful start, hasn't it, to the new year? Hang Seng hit a 14-month low, down about 4.4% now since the beginning of the year. That's the worst start to a new year since 2005. Seems to be carrying on where we left off into 2023.
Yeah, I just don't see any end to the gloom and doom carry over from last year, because if China's economy does not improve, and if the tech sector in China does not improve, I just don't see any chance for the Hong Kong market to rise substantially, say to even 20,000. So I think we will continue to short the market.
And in the meantime, you've got some nice opportunities elsewhere, like Japan, for example. It's at a 33-year high.
Even Japan, South Korea, even Taiwan and India and the US are much better bets. So this smart money already went over there already. So just about everybody's leaving Hong Kong except for the old people.
Carlos, what are your thoughts? I mean, what could be the catalyst here to try and get a turnaround? Could rate cuts in the US do it?
Rate cuts in the US would help in the sense that they reduce the cost of capital in Hong Kong as well. But I agree with Francis. I think catalysts on the upside are quite limited. We have some big heavyweights in the index that will see very low single-digit earnings growth in 2024. Even with all of the policy stimulus and sort of lighter touch approach to regulation. And so what is happening is that you have investors that have underwater positions that will utilize any rally to diversify into new growth sectors, such as EVs in China. So that means that by default, due to technical reasons, there is going to be a ceiling on any rally in the Hang Seng Index. And I think it's something that will last a few years. In order for us to see more sustained growth, you would have to see basically a rebalancing of the constituents of the index with the new technology sectors, biotech, EVs, and these kind of names weighing more than some of the older growth sectors such as e-commerce. So not anytime soon. Luckily for investors in the region, I agree with Francis, lots of other markets are looking quite interesting. Japan, for example, is the most exciting it's been in many decades. And India, where we it's one of the few places in the world where there's a positive correlation between growth and total equity returns. And we are assuming that growth will remain high, around 8% in the next 10 years. So that is a market where we think investors should consider to strategically pivot whenever there is an opportunity, meaning valuations look slightly more attractive. And of course, in the US, the Magnificent Seven have driven most of the returns in 2023. Looking a little bit overpriced, but the AI theme continues, and some of the software companies have derated and are looking attractive, and so could be potential beneficiaries of the next leg of this AI theme. So there are a few opportunities out there, with the Hang Seng Index probably remaining a little bit more subdued this year.
Well, fascinating times, and thank you very much for a very interesting discussion this morning. Have a great weekend. You heard there Carlos Casanova, who is Senior Asia Economist at UBP, and Francis Lun, who is the CEO of GEO Securities.
Peter Lewis's Money Talk.
I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Morning, Toby, and Happy New Year.
Yeah, Happy New Year and good morning to you, Peter.
Thank you very much. Now, the annual consumer price inflation rate in the US rose 3.4% in December. That was up from the previous month. It was 3.1% the previous month. It was also above what economists were forecasting. Similarly for the core inflation rate as well. It eased to 3.9%, but also above expectations. I guess this is signalling that inflation still isn't fully beaten yet in the US.
Yeah, I think that's a fair statement. I think one of the governors, Williams, spoke earlier in the week, and he said that, restrictive monetary policy likely to continue until they're very much convinced that they've got inflation licked. This number didn't really have a huge impact on the market. There was the swings and roundabouts, but it probably moved the the betting market, if I use the betting market being the futures market, probably took about the expectation of a March rate cut to 65% from 70% or thereabouts, I think. And overall, I think it tempered a little bit of the enthusiasm that we've seen since the beginning of December, where Goldilocks has been the sort of favoured scenario for the landing in the US economy.
Does this change the trajectory of rate hikes for the Fed?
No, but it may be it may not change the Fed's view, but it may change the market's view of the Fed, if that makes sense. I think the market's probably a little ahead of itself, and maybe it's just tempered back to, the Fed have never really been so, dovish to suggest that, that the market should be imminently expecting a rate cut. I think they've been pretty consistent in saying they're pivoting towards 3 at some point this year, but I think the market got a little ahead of itself, a little excited. So I think it's probably more the market reacting rather than the Fed.
It does, though, make it difficult, doesn't it, for a rate hike in March? Because if the Fed is going to do that, it's got to really start preparing the ground at this meeting at the end of January, because that's the last one before March. It can't just suddenly turn up in March and cut rates. But maybe it's a little bit difficult and a little bit early for it to start doing that in January.
Yeah, my sense of it is it's a bit premature. And again, I'm not speaking for the Fed or have any insight, that's for sure. But I sense that they're more likely to hold fire for as long as they can. I think the acceleration in a rate cut would be if they see the economic data really slipping quickly, i.e. they see some really soft economic data that suggests that we might be slowing much more aggressively, and it's just not happening. I mean, you saw jobless claims figures last night that were slightly better than expected. The payrolls number was good. The manufacturing figures seem to have improved somewhat on the US economy. So it's hard to see the economy is about to tilt into a much sharper decline, which would accelerate the timing for the Fed. So I suspect they'll buy as much time as they can.
So the Fed has done a good job, I suppose, hasn't it, on inflation since when, June 2022, when it started raising rates. But where do we go from here in terms of the inflation picture?
I think it's probably it'll be higher for longer. I think we were talking a lot last year. I think throughout the year that if for nothing we're going to see rates higher for longer. Now, even with the cuts that have been forecast for this year, it's still going to keep rates well above, I guess, maybe between 375 and 425 on the discount rate for the US Fed funds. So 75 basis points this year probably is where the market's priced, and that's probably the most reasonable expectation at this point in time. And then I think the following year, another 50 to 75. So let's say 1.5% over the next 2 years off 5.25 puts you, just under 4%, which is still relatively high historically. But that'll all be contingent on how the economy performs.
And of course, we have got this CPI data isn't the Fed's preferred measure. We have got the PCE data coming out before the end of January as well, which the Fed seems to put more attention on, doesn't it, than this CPI data.
Yeah, and I mean, you're getting a diminishing return on this data as we've got we had very high inflation driven by the supply shock, and that's come off quite aggressively. So all of the big moves in inflation have happened. So now we're sort of getting marginal improvements in the inflation readings. What they don't want to see is a spike the other way. So they want to see, even if it's flatlining a little bit, as long as it's not rebouncing. And again, you've got other exogenous factors. You've got geopolitically, you've got oil markets, energy markets potentially being a little bit choppy. You've got this Taiwan election on the weekend that might have an impact. So lots of things to look out for. So it's not just the economic data that we're keeping an eye on.
I mean, that is where the risks are, isn't it, to the upside? When you hear about oil tankers being taken over by Iranian rebels or Houthi rebels, then it makes you realise there are still risks, aren't there, on the supply side?
Yeah, and I think if one thing we were talking to, we feel that most of the really good news is priced into equity markets. Hence, it's more likely to see disappointment rather than joy over the couple of months. So, not to say that we're negative, it's just that, the market's pretty well priced for everything happening according to plan, and that often isn't the case, as we know, having been in the markets a long time. So I think the market's probably needs to just be a little bit more tempered in its enthusiasm for the Fed policy and where the economy is tracking this.
And what about inflation in Australia? It's down to a 2-year low, isn't it? I think around 4.3%.
Yeah, well, 4.3% versus 3.2 in the US tells you a story as well. We've got a target here that the RBA looks at 2 to 3%. So 4.3 is still a fairly good number in terms of improvement, but well off the target. As with the more, I guess, the more studied number for the RBA will be at the end of the month when we get the quarterly figure. And that currently has inflation on a year-on-year basis over 5%. So we'll be certainly looking for something with a 4 handle to give a chance for the RBA to be on hold. Remember, the Australian economy is a bit behind in terms of cycle on inflation. And the risk here is that we have slightly more persistent inflation and that the RBA, given that interest rates are below the US interest rates, potentially could have to continue to hike. Unlikely at this immediate point in time, but we'll be looking at that inflation data at the end of the month quite closely.
What about the markets? We had a big rally for the last 3 months of 2023. Things came off quite rapidly in the first week of the year, but now suddenly we're back up certainly in US stocks, close to all-time highs again for the S&P 500. The markets still seem to be pricing in this Goldilocks scenario, don't they, of inflation coming down, but the US economy not tipping into a recession and earnings growth continuing to hold up.
Feels that way. You know, it was certainly an excellent month in December to finish off the year, and the new year's been a little more choppy, obviously due to light conditions as well as plenty of people away on holidays coming back into it. It's still looking fairly structured. I think at some stage, what knocks the market off its confidence will be data out of inflation and maybe an exogenous risk. So at this stage, it's looking pretty good. As I said, the market's priced for pretty much everything going well, so that worries me a little. So I'm not surprised if we see some pullbacks at some stage.
And earnings season starts today. The big US banks kick off with their reporting. How important is this earnings season going to be to what the market does going forward?
Definitely important, and obviously forward estimates for companies will be the thing that will be looked at closely to see if there's any decline, not only in the actual performance of the last quarter, but also the forward estimate. And I think I read somewhere, and again, I just avoid being specific here, but Citibank, I gather, made some provision or expected to make some provision, quite large provision on in its books for its earnings results. So I'll be interested to see if there's some of the banks making some extra provisions for potential slowdown and higher default rates. So we'll be watching that data really closely and particularly looking at the forward estimates.
And if this rally is going to continue, we're going to see the S&P 500 move to all-time highs and continue beyond that. What's got to happen to keep it going?
Well, I think the scenario is that we end up with change from a soft landing to a no landing, i.e. we continue to grow at a reasonable clip. Inflation comes off and rates start to come off. There's no reason to suggest that wouldn't lead to the equity markets continuing to trade new highs. Volatility's low, almost not at all times, but at historical lows. All indications are at this stage that investors are pretty comfortable with how things are looking, and they'll probably continue to buy it because there's still a lot of cash on the sideline, right? Even if you're getting a good earn off cash that's yet to be deployed, if there's a risk-on view and the Fed start to affirm their view on rates, it could be a nice little kicker for investors to buy into equity risk.
It does seem, doesn't it, that a lot of good things have got to happen all at the same time or continue to happen at the same time for this to keep going. But I suppose so far that is exactly what has happened.
Well, it's a world for optimists, I think, Peter. You know, you and I have been seeing a lot of things in our time, and you know, there's always surprises, but there's no reason right now not to be optimistic. You know, the parameters are fairly well set. The big caveat on that is we just don't know what's going to happen, right? So we're always mindful, but on balance, it's looking fairly well structured at the moment, and a good reason why the markets are trading where they are.
Well, it's going to be a fascinating start to this year over the next few months. Look forward to talking about it more with you over the coming weeks, Toby. Thank you very much indeed. That's Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you very much for listening this morning and this week. Don't forget to take a look at my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and John Schofield, Managing Director of Tempus Investment. Providing a view from mainland China will be Yanan Wu, the Chairman and CEO of Surfing Group, and with an update on the Taiwan election will be Ross Feingold, Business Development Director at SafePro Group in Taipei. Have a great weekend.
Money Talk.